You make $6,800 a month. Sounds like a solid income? Then rent or mortgage takes $2,400. Car payments, $800. Insurance, groceries, utilities, student loans. By the time you're done, you've got maybe $130 left. And that's before your kid needs new shoes or your dog starts limping or anything unexpected happens at all. So every Monday morning you get up and drive to a job you'd leave tomorrow if you could, except you can't, because $6,670 of your $6,800 is already spoken for before you earn it. That's not a career problem. That's not a motivation problem. That's a math problem. And today I'm going to show you exactly what happens to your money, your options, and your entire life when you solve it. Because the people who escape this aren't the ones who earn the most. They're the ones who figured out the number that sets them free, and then they went and hit it. Let me show you what the rat race actually looks like in dollars, because most people have never sat down and mapped it out this clearly, and when you do, it's genuinely hard to look at. Meet the Mitchells. Dual income combined $110,000 a year. By most standards, they're doing well. They both went to university, both work full-time, they don't live extravagantly. No boat, no luxury holidays. They are two professional adults who did exactly what they were told to do. After taxes, pension contributions, and national insurance, they're taking home about $6,800 a month. Now watch it disappear. Mortgage on their house, $2,400. Property taxes, $380. Home insurance, $200. Maintenance because the boiler doesn't care that it's December, $320. That's $3,300 a month just to legally live in the building. They've got $3,500 left. 2 car payments because they both commute, $800. Car insurance, $240. Fuel because nothing is walkable, $280. Student loans, $550. Health costs, $380. Groceries for 2 adults trying to eat properly, $700. Utilities, electricity, water, internet, phones, $420. We're at $130 remaining, and we haven't touched clothing or the kids' school trip or the vet bill from last week or any savings beyond that modest pension contribution or any concept of fun whatsoever. The Mitchells are not irresponsible. They have never been irresponsible. They are 2 people who followed the script perfectly and ended up with $130 of breathing room per month. And here's what that actually means for their lives. Every single decision they make gets filtered through one silent question running in the background like a browser tab they can never close. Can we still cover everything this month? Want to leave a job you hate? Better check if you can still cover the bills. Want to start something on the side? Better make sure nothing disrupts the income. Want to take a pay cut to do work that actually matters to you? You can't. The obligations won't let you. That's the rat race. It's not the job, it's not the commute, it's not your boss, it's the expense floor. It's the total of every mandatory payment you owe every month. And when that number is close to what you earn, you have no options. You go where the money tells you to go. You stay where the money tells you to stay. And you do it for 30 years because the math requires it. Now here's what most people miss. Your income isn't what traps you. Your obligations are. Someone earning $50,000 a year with $1,500 in monthly obligations has more freedom than someone earning $150,000 with $12,000 in monthly obligations. The second person has a nicer house and a better car and a more impressive job title, and they also can't miss a single paycheck without their life starting to unravel. That's not wealth. That's a very well-decorated cage. So the escape isn't about earning more, it's about needing less. And the math of how to do that is more straightforward than most people think. It's just not easy. Let me walk you through what actually happens when you start dismantling the expense floor, stage by stage, because each one unlocks something specific. Stage 1, kill the consumer debt. The Mitchells are carrying $800 a month in car payments, $550 in student loans, and let's say $200 in credit card minimums they don't talk about. That's $1,550 a month in consumer debt payments. Almost a quarter of their take-home pay, gone, every month, paying for things that are either depreciating or already consumed. Now, paying this off isn't glamorous. It's 18 to 36 months of throwing every spare dollar at balances, selling the newer car, and buying something ugly that runs, picking up extra shifts, cutting things that hurt to cut. Nobody films a montage of this part because it looks like eating rice and saying no to things for 2 years straight. But here's what happens on the other side. That $1,550 a month comes back. Their breathing room goes from $130 to $1,680, and that changes something fundamental about how they experience their daily life. For the first time in years, an unexpected $400 expense doesn't send them into a spiral. They can absorb a bad month, they stop checking their bank account with dread, the background noise in their heads gets a little quieter. And here's the part that matters for what comes next. That $1,550 is now available to attack the big one. Stage 2. Kill the mortgage. This is where the numbers get genuinely staggering, and I need you to pay attention because what I'm about to show you is the single most important financial calculation most people never run. The Mitchells' mortgage is $2,400 a month on a 30-year loan. Let's say they bought a $380,000 house at 6.5%. Over the full 30 years, they will pay roughly $546,000 in interest alone. That means the bank collects more in interest than the house cost in the first place. It's a beautiful business model, if you're the bank. Now, once their consumer debt is gone, they take that $1,550 and start throwing it at the mortgage principal on top of their regular payment. They're now paying roughly $3,950 a month on a $2,400 mortgage. What does that do? It cuts a 30-year mortgage down to about 12 to 14 years from that point. It kills somewhere between $250,000 to $300,000 in interest payments. That's not a small number. That's a house. They just saved an entire house worth of money by redirecting cash they were already spending on depreciating assets. Now, some of you are already typing, but if their mortgage rate is below 5%, they're mathematically better off investing that money instead of prepaying. And look, you're not wrong. If you take a $500,000 mortgage at 3% and invest the excess payments in an index fund returning 8% historically, investing wins in about 95% of 30-year windows. The spreadsheet is clear. Here's what the spreadsheet doesn't account for. It assumes you actually invest the difference. Most people don't. They spend it. The mortgage payment was forced discipline. When it becomes discretionary cash, a terrifying percentage of households absorb it into lifestyle inflation within 18 months and have nothing to show for it. It also assumes you have the stomach to watch your portfolio drop 40% in a market crash while you still owe $2,400 a month on a house. That's a fundamentally different experience than watching the same crash from a home you own outright. One scenario is uncomfortable. The other is how people end up making catastrophic financial decisions under pressure. And here's something else. Research shows that carrying debt actually impairs your ability to think clearly about financial decisions. So you've been making the should I invest or pay off the mortgage calculation from a cognitively compromised position, which is a bit like asking someone who hasn't slept in 3 days to navigate a complex map. Above 7% interest, which is most people who bought since 2022, aggressive payoff is a guaranteed return that's hard to beat. Between 4.5% and 7%, it's a genuine judgment call. Below 4.5%, the math favors investing, but only if you'll actually do it and not let it quietly become better restaurants and a nicer car. The real answer isn't a rate, it's knowing yourself. But let's say the Mitchells pay it off. Let's say they get aggressive and kill the mortgage at year 22 instead of year 30. What actually changes? When the mortgage disappears, they don't get the full $2,400 back. Property taxes, insurance, and maintenance still exist. On a $380,000 home, that's roughly $900 a month in ongoing costs. So they've freed up about $1,500 a month in real, deployable cash. And here's what $1,500 a month does when it's invested in a low-cost index fund returning around 8% annually. In 5 years, roughly $110,000. In 10 years, about $274,000. In 15 years, roughly $520,000. In 20 years, over $880,000. They contributed $360,000 of their own money over those 20 years. The market contributed over $520,000 on top, more than they put in themselves. The majority of their eventual wealth didn't come from working harder. It came from compound interest finally having room to work because the bank was no longer in the way. Stage 3. Here's where it all comes together. Before the debt payoff, the Mitchells needed both incomes running at full capacity every month just to survive. Their expense floor was $6,670. After consumer debt and the mortgage are gone, that floor drops to roughly $2,720. Taxes, insurance, maintenance, groceries, utilities, fuel, health costs. In financial independence terms, there's a simple formula. You need roughly 25 times your annual expenses in invested assets to live off your portfolio. At $6,670 a month, their independence number was $2 million. At $2,720 a month, it's about $816,000. They didn't earn more money. They didn't get a promotion. They didn't launch a tech startup. They just changed what survival costs. And that single change moved the finish line $1.2 million closer. That's not motivational fluff. That is the most important number in personal finance, and almost nobody calculates it. Now, here's the part that nobody in personal finance talks about. And once you hear it, you won't be able to unhear it. Every $500 in monthly obligations you carry isn't just $500 a month. To sustain that obligation indefinitely, you need roughly $150,000 in invested assets generating returns to cover it. So that car payment you think costs $400 a month. It's actually $120,000 of your future net worth. That subscription bundle running $150 a month, $45,000. That lifestyle upgrade you justified because you got a raise. Run the number. Multiply the monthly cost by 300. That's what it actually costs you in financial freedom. When you look at your expenses through that lens, every line item on your budget isn't a monthly cost. It's a chunk of your life you're trading for it. And suddenly the question isn't, can I afford $500 a month? It's, is this worth $150,000 of my freedom? Most people have never framed it that way. The Mitchells didn't until they did. And once they saw it, they couldn't unsee it. Every spending decision started running through a different filter. Not, can we afford this? But what does this cost us in years? So let's go back to the Mitchells at year 22. Mortgage gone. Consumer debt gone. Expense floor sitting at $2,720 a month. On their combined income of $6,800 take home, they now have over $4,000 a month in free cash flow. And this is where their lives start looking completely different from the outside, even though nothing about their income changed. Mrs. Mitchell has been in a management role she's tolerated for 8 years. Stable, good benefits, soul-crushing. There's a position at a smaller company. More interesting work, better hours, $12,000 less per year. 2 years ago, that pay cut would have been impossible. The mortgage wouldn't allow it. Now, $1,000 a month less when you have $4,000 in breathing room is a completely different calculation. She takes it. Mr. Mitchell has been talking about starting a contracting business since 2021. But the risk was never viable when one bad quarter could mean missing the mortgage. Now, their fixed costs are low enough that even if the business earns nothing for 6 months, they don't lose the house. They don't even lose sleep. He starts it. They're not rich. Nothing about their life looks like a finance influencer's Instagram. They drive the same cars. They live in the same house. But they're making decisions based on what they actually want instead of what their obligations require. And that is the thing that changes everything. This is what escaping the rat race actually looks like. It's not quitting your job to travel. It's not passive income on a beach. It's a $2,720 expense floor instead of a $6,670 one. It's the distance between those two numbers. That distance is freedom, and you can measure it in dollars. Now, let me handle the objections because I know they're coming. But you need a high income to pull this off. You really don't. Reducing your expenses by $1,000 a month has the same financial impact as earning an extra $15,000 to $18,000 a year pre-tax, depending on your bracket. And cutting expenses is entirely within your control tomorrow morning, while a $15,000 raise is not. The math actually favors the expense reduction side once you're past a baseline income, because every dollar you cut comes off your independence number permanently, while every dollar you earn gets taxed before you see it. But what about investing instead of paying off the house? We covered this, but let me put it simply. The mathematically optimal strategy only works if you execute it perfectly for 20 to 30 years. Never panic sell, never redirect the money, and never lose discipline during a downturn. The debt elimination strategy works if you just keep paying. One requires exceptional behavior, the other requires consistent behavior. Know which one you are. But what if the market crashes right after you leave your job? This is actually the strongest argument for getting the expense floor low before you make lifestyle changes. If you still owe $2,400 a month on a mortgage when the market drops 40%, you're trapped. You can't reduce your income. You can't take a risk. You can't even breathe. If you own the house outright and your expenses are $2,720 a month, the same crash is uncomfortable but survivable. You can write it out from a position of stability instead of desperation. Sequence of return risk is real, and a low expense floor is the single best hedge against it. All right, let's say you get there. Consumer debt gone. Mortgage gone. You've got $1,500 to $4,000 a month in freed up cash flow depending on your situation. Here's exactly what to do with it, in order, because the order actually matters. First, and I know this sounds boring, but it's the most important step, rebuild your emergency fund. You've been house poor for years. Your reserves are almost certainly thinner than they should be. Get 6 to 12 months of your new, lower expenses in a high-yield savings account before you do anything ambitious. At $2,720 a month in expenses, that's $16,000 to $32,000 in liquid cash. That's your buffer. That's what lets you take risks without the downside being catastrophic. Second, if your employer matches pension or retirement contributions, max that out immediately. If they match 50% up to a certain percentage of your salary, that's a guaranteed 50% return. Nothing else on this list comes close. Third, max out any tax-advantaged retirement accounts available to you. In the US, that's the Roth IRA at $7,000 a year. Money that grows and comes out completely tax-free. Then the 401k up to $23,500. If you have access to a health savings account, fund that too. It's the most tax-efficient account that exists. In the UK, ISAs. In Canada, TFSAs and RRSPs. Whatever your country offers that shields growth from tax, fill it up. Fourth, everything remaining goes into a standard investment account with low-cost, broad-market index funds. Not individual stocks, not crypto, not your cousin's startup. A boring, diversified portfolio that has historically returned 7 to 10% annually and requires almost no attention. If you're deploying $2,000 a month through this system at an average 8% return, here's where you land. 10 years, roughly $365,000. 15 years, roughly $693,000. 20 years, over $1.1 million. Not because you did anything clever, not because you timed the market or picked the right stocks. Because you eliminated the obligations that were eating your income and you gave compound interest the room it needed to do what it was always going to do if you just cleared the path. Let me bring this back to where we started. The Mitchells 5 years after escaping, they're not on a yacht. They're not retired at 40. They still work. But Mrs. Mitchell works at a job she chose because she wanted it, not because the mortgage required it. Mr. Mitchell's business had a rough first year and a decent second year, and at no point did either of them lie awake at night doing that math. Because the math is different now. The background noise is gone. The tab is closed. The rat race was never the job. It was the gap between what you earn and what you owe. Close that gap, not by earning more, but by owing less, and the race ends. Not because you stopped running, because you stopped needing to.